Hello again, everyone. Welcome to the Options Mentor. And once again, we had a little bit of crazy movement in the market this week. Had a pretty good sell-off on Friday after the Fed chair said the day before that they weren't really in a hurry to cut rates further. They could be patient. Of course, the market doesn't like that. Drove the market down, also drove the VIX up. As I look into next week, there's really not all that much, scheduled news there. There's some Fed speakers I'm sure will have an effect on the market. And there is also a report on Friday. I forget which one it was, but I don't think that it'll be that significant. So I do think that this coming week, even the week after Thanksgiving week, should be a decent time for the market to trade a little more complacency, a little more manageable range. So I will talk to you today about a trade I think looks good for that this week. And I also, after that, I'm going to go over today how I select what trades I'm going to do. I get asked this all the time. How do you decide what trade that you're going to do each day or whatever, or whenever you're getting into one? I'm going to review that a bit here after I talk about a trade for this coming week. So let me share my screen here, and we will be looking at a VIX chart. So the VIX chart here shows, we were up at all-time highs. Now we've kind of sold off a little bit. VIX is, this is the SPX chart. We've done that. Then the VIX itself has rose up a little bit. It was all the way down in the 13s the other day, which is great. I was looking forward to doing some calendars this week, but now that VIX is elevated a little, that causes a little more pause. So the trade I'm looking at this week in the SPX is a double long diagonal. And I went out to the 29th for that, which is a week from this Friday. So the double long diagonal requires, of course, when I do double diagonals or even diagonals, they're always what I call long diagonals. Long diagonal means that the long for the on each side is purchased ahead of the call, meaning that it will come into the money sooner than the short call or the short put will. Here you go. For example, I use Friday's close, 58.70. If we go up here, I went up about 50 points to 59.20. And then I sold to 59.25. You see the long is going to be in the money first. And down on the downside, I did 58.30 for the long and 58.20. We're about 10 points closer on the downside than the top side because volatility will help you here if it goes down, and you can usually be a little closer with your put diagonal than your call diagonal. But what we're really looking for is it to just trade sideways inside of our graph, our expiration graph, where this blue line is above the zero line, and just pick up our theta. Starts out about 60 bucks a day in theta. And I would be looking to get out of this trade at 8 or 10% profit, hopefully by this Friday. And if you look at this Friday's expiration, that's the 22nd. Let's look at that real quick. The 22nd, we're about 100 points on the expected market maker move between now and then, plus or minus $97.32. So when I built this, I wanted it wide enough to really stay in that range. And take a look. If we go up 100, we're still inside this expiration graph. If we go down 100, still inside the expiration graph. So this looks really good here for this trade. That's why I like it. I look to get 8 or 10% of what I paid for it. Right here, it's trading for $11.25, maybe $120, and get out of it. And if we just tick forward on the date here, which just shows what time decay would do for you, by Thursday, we could certainly be out of this trade, maybe even Wednesday, just on time decay. Now, remember, volatility is also a factor, so it can help us, it can hurt us. That's around $113.90 per point of it working for us or against us. So this is the kind of trade, hey, try this out on paper. You certainly shouldn't do these trades live if you've never done them before. Try it out on paper, see what you think. And don't ever do any trade live till you've done that, and make sure it's, of course, right for you and your situation. One other thing, like I said, I would talk about today is how do I decide what trade I'm going to do? Well, what I like to do is use the VIX. So I'll look at the VIX. We can see it's 16.14. Now, I will talk about my very rough guidelines. It doesn't mean I'd never do a trade that didn't fit these guidelines, but I pretty much stick to it. And that is, if we're under 15 on the VIX, I prefer calendars. They're long vega, better in low volatility environments. They have great time decay. I really like them, especially when you get to 12 and 13 on the VIX. That's why I was looking forward to doing some this week before the VIX got a little higher. Now, you could do them here at 16. I just expect over time that performance probably wouldn't be as good. So that's calendars under 15 on the VIX. Next, let's talk about diagonals or double diagonals like this. I like to do those from 14 to 25 on the VIX, and I've done it in all that range and had success. I think they really shine between 15 and 20 on the VIX, but it doesn't mean they won't work down to 14 or up to 25. I've had them work just fine. They do seem to tolerate volatility going against them a little bit better than calendars. That's why I'll do them in a higher environment. Also, with the double long, you're getting so wide, which is very nice, gives you a lot of room for the price to roam. That's what we want. We want to put a trade on, let it roam around, and let our time decay come off. That's why I call them non-directional. It can go up some, it can go down some, and we can still make our money. So then that leaves butterflies. Butterflies, I like to do from about 15 to 25 on the VIX, sometimes 14 to 25. That's when I would do butterflies. Now, when I do butterflies, I like them to be at least 3 weeks out. So probably go out to like December 6th, which is out here on a Friday. And then if you did a butterfly, let's just say, for example, I did one, let's see, we're at 58.70. I'll just put one there at the money. And I'll do a butterfly here, probably asymmetrical because then it's flatter. Maybe go up 70 points to, that would be 59.40. Down 70 points to 5,800. There you have it. Let's take a look at it. In the risk profile, we got to get rid of that double diagonal. There you have it. Now you can see with this, it does taper off a little more on the upside than the downside. But we are, oh, wait a minute here. This should be down 80 points, my mistake. So up 70, down 80. So if we're at 58.70, if I go up 70, I'll be selling or buying the 59.40. And if we go down 80, I'll be at 57.90. So 80 down, 70 up gives us a pretty flat graph. You are down a little more on the upside than the downside. But I like it this way. I don't like to come in closer because look what happens whenever you do come in a little bit closer. Let's say I even did this for the 29th. Look what happens. It tapers off much. You're up down over $200 on the upper edge. That's why I like at least 3 weeks on a fly. You know, my all put fly is 35 days and more out. I've done flies 60, 70 days out. Perfectly fine. There's really no limit to how far out you can do. What you would get from that is, of course, slower time decay, but you'd also have a trade if it went against you, would hurt you a lot less if you have more time on it. So that's butterfly. So butterflies roughly 14 or 15 up to 25 on the VIX. So that's my ranges for trades. Let me just model a calendar here real quick. Just to talk about it a little bit further, these different guidelines. So let me get the 22nd, no, sorry, 29th, and I'll just buy a calendar just to model it right around the money, which is what I normally do with calendars. I normally put them somewhere right around where we're trading. And so a calendar, something like this. So once again, under 15, usually like calendars, 14 to 25 diagonals, 14 to 25 flies. Of course, there's some overlap there. So how do I decide there is that overlap? So let's suppose I go into tomorrow and I have nothing on at all. What would I do? I'm going to go over and look at the VIX. It's at 16. Most likely what I'm going to do is a double long diagonal. I don't know which way we're going, so I just want to have a lot of room. So that's probably what I would choose. Completely viable if you want to do a butterfly. And you could even do a calendar. Probably the calendar would be my last choice with the VIX at 16. So another factor that can come into this is I don't generally want to do two trades that are separate from each other in the same expiration. For instance, normally I wouldn't do a double long diagonal and a calendar in the same expiration. You can do it, but I consider that a little bit more advanced. You need to really have what you're doing down pat, because you got to be careful. You could walk on other strikes, take off strikes that you didn't mean to because you were maybe putting on one trade, and when you did, it took off part of the other one. So you got to be careful. So I think that's a fairly advanced thing to do. I don't usually do it myself, but I do occasionally. So that's a factor. If you already have this trade on, let's say I come into tomorrow, I've already got on a double long diagonal. What if I did? What could I do? Well, I could still look at a butterfly. It's out even further. So I just probably pick from one of the other trades. If I already have one of them on, I'll probably look at the others. For instance, a double long diagonal, I already have it on. I might look at a fly. You could even look at a calendar. Now, if you wanted to do the calendar, yes, you could do it for the 29th. But like I said, I think that's a little bit more dangerous. What I would probably do is come out to December 6th, the following Friday. And that's about as far out as I like to get with long Vega trades. About 2 weeks from the Friday of the week we're in is about as far out as I ever get with long Vega trades, whether they're diagonals or calendars. And in flies, I have that 3-week minimum. You can do as far out as you like. So if I already had a double long coming into tomorrow, then I might even add a calendar here or a fly. Now, if you came in tomorrow and you had a calendar on, and I saw 16 on the VIX, I would definitely be going with the double long. And if the calendar was already in, say, the 29th expiration, then I would go to the 6th expiration for that trade. So now let's say I did that. I had the calendar on, and then I come in and put on the double long. Now I have those two trades on. Now it's maybe Tuesday, Wednesday, and I want to add one more trade. I only like to have 2 or 3 trades on at once. I just make them bigger if I want to get more capital deployed, because if the market goes haywire, I like having very few trades to deal with. So I'd rather have even 2 or 3 large trades to deal with than multiple smaller trades. That just gets a little hectic. So if I came into this week, I already got on a calendar. I added a double long diagonal tomorrow if the VIX was here. Maybe wait a day or two. I want to do one more. Let's say the VIX is here or maybe a little higher. Well, I'd probably go with the fly, going out at least 3 weeks. And now I have on 3 trades. That's going to be it for me until one of these comes off. And then when one of them comes off, you can look at another one. But what if I came into, maybe had the double long on already, then maybe tomorrow I added a calendar. And what if I want to add one more trade? I get to Wednesday and the VIX is 13. The VIX is 13. What would I do? Well, I'd really like to add another calendar. So if there were any expirations available inside that 2.5-week period, I would add a calendar. What I would probably do if the VIX was that low and I already had on the double diagonal and the calendars, I'd probably just not put on another trade. So I don't want to jam a third trade in or even a second trade with volatilities that are not right for it. I like to put trades on in the right volatility environment. And I just want to cover something here. Sometimes this confuses people. They'll say, hey, Mark, the VIX was at 16. I put on a double long diagonal. And 2 days later, the VIX is at 20. Should I take it off? No, you don't have to take it off because the VIX changed volatilities. It's just what I do when I'm going to put it on. The general rule, the idea being that a double long diagonal works great in lower volatility environments down to around 14 and even higher. So it's a good volatility environment for one, so I'd put it on. Just like if the VIX was under 15, maybe even 13, I'd rather do a calendar. Does a little better in those low vol environments, has a faster time decay. So that's how I would decide that. So if I come in and I don't have anything on, I look at that VIX and pick whatever trade fits for that. And then the second trade, I try to do that again. And then the third trade you can put on as long as it makes sense, meaning that if it's 13 on the VIX, I already have a calendar and a double long on. If I don't have a Friday available in the next 2.5 weeks, I'll probably just skip it and wait till one of these comes off. And then I can look and see where the VIX is then and handle that. So then you might say, well, one more thing, Mark. What do you do if we woke up tomorrow, things went haywire, and the VIX was 30? I'm not doing anything. If the VIX is over 25, I'll just leave trading alone. Occasionally, if it seems to be there's going to be a lot more big moves, very short period, I might do something like a back ratio, which I've covered in other videos. And also occasionally we've had these, if you look back at a VIX chart, this doesn't happen very often, to be honest, but you can have a situation where we have a sustained high volatility. Now that hasn't happened in a while, but it does happen sometimes. In the past, it's happened where we were above 25 for the most part for a while. Look at this back here, above 25 a lot of times. If it's sustained over there a couple, 3 days, you could consider flies. If I wanted to do that, I'd make them very wide to give me room because higher vol usually is at least telling you the market's erratic, could be big moves. So I want to be out at least 3 weeks, really wide, and I certainly wouldn't do them as large, and I certainly wouldn't expect as much from them. A success rate over time, because when you're doing things above 25 on the VIX, it can be very scary, with the price movements. So one of the things, folks often say to me, though, Mark, hey, the VIX is really high. These option premiums are crazy. Don't we want to get in on that? Well, with non-directional trading, you really don't want to do that if the volatility is too high for a particular trade style, even if the premiums are great. An example I often use is if an insurance company is selling car insurance, and you might have noticed with your own kids or maybe yourself, if you're a 16-year-old boy getting car insurance, you're going to pay a very large premium, just like you're going to get a large premium if you sell options in a high volatility environment. Well, why do they charge 16-year-old boys a high premium? Do they not like them? Do they somehow like 60-year-old folks better and give them a lower premium? No, it's not about that. It's about the fact that they have more accidents, right? So if a 16-year-old boy is going to have more accidents, you're going to pay more premium. And whenever you're, older, you'll usually pay less. And it's the same thing in the VIX. If the VIX is high, you're going to get a lot more premium, but it's for a reason. The reason is there could be more accidents, right? More things that could go against you. So that's why I prefer not to do a lot of these type of non-directional trades with the VIX above 25. But thankfully, it doesn't happen all that often. It's not like you're going to be on the sidelines, usually for an extended period. If you are, like I said, you could dabble in maybe back ratios and maybe some really wide butterflies. So I'm going to recap once more here. And that is under 15 on the VIX. I prefer calendars if I can. 14 to 25 on the VIX, I prefer diagonals. Well, I don't prefer, I will do calendars or I'll usually do diagonals. I'll do calendars in a rough range. I like them under 15. I don't do calendars above 18 or 20. Double diagonals, I like from 14 to 25, and flies about 14 to 25. So I just realized I did omit that. I do have an upper end to calendars, usually 18, like I said, to 20. I don't do calendars at all. So if I already had one of these on, for instance, put that on tomorrow, maybe Tuesday, put on a butterfly, and then the VIX is high, maybe 20, 23 on Wednesday or Thursday. Well, I'm not putting on a calendar, right? So if you can't fit another fly in further out, or maybe a double diagonal or diagonal in the next 2.5 weeks on a Friday, then I would just stand aside, right? And just go with the trades I have on. So that's really how I look at it and how I decide what trades I'm going to utilize. There is some leeway in there, but I did give you my preferences in each range. And like I said, sometimes you can't do the trade you want to do the most because the vol range isn't right. So you have to do something else. But that's how it is in trading. You don't want to force a trade on. You want to do the trade that gives you the best chance at success. That's why I did this double long, for example, and I did it really wider than normal because it gives us the best chance for success. If the market maker expected moves 100 points over the next week, and I want to be out here in the next week, that gives us the best chance for success. That's why I like to do it that way. Oh, and one other thing I want to point out, when volatility is really high, things like calendars or even diagonals will look terrific. They'll be super wide and look really great. That's because they do look great in higher volatility. The problem is, what does higher volatility mean when we're at 20 or something? If we're at 20 on the VIX, the greater chance is that VIX is coming down than going up further. So that's why, even though they may look terrific, a calendar looks really awesome. If you ever model one at 25 on a VIX, looks terrific. And it could work there if the volatility didn't come down. So if you put a trade on like that at 25 and the VIX stayed there or maybe went higher, well, the calendar would be fine. But the problem is often when we're in a high VIX environment, just look at that chart, you can see that we often come back down. The VIX has a habit of spiking and coming back down. That's what it does. It doesn't normally stay up in a prolonged period. Most up moves are short, and then you kind of trend along. So you have to be careful with that. But that's a little insight into how I select my trades. If you want to know how I manage my trades, or even want to follow the trades I do live, I do have a trade alert service. Go over to arimer.com, link in the description there, and you can follow me with the trades I do. You can also take the different sessions I do every week where I go over how I manage trades. So that's what I have for today, folks. Don't forget to hit the like and subscribe. This channel is absolutely blown up in the last few weeks. I really appreciate that. Please tell your friends, and I look forward to going over more things with you in the future. I am going to try many times to do these a little bit longer format videos than I had been doing. I've been doing a lot of just short videos on just the trade I'm looking at this week. This week, of course, I did that, but what I want to do is show you a trade maybe I'm looking at for a coming week, and then go over some concept. So that's what I'm going to be doing going forward. So just different ideas like, how do I select generally what trade I'm going to do like I did today. Well, thanks again for coming out, folks. I really do appreciate you. Have a great trading week, and I will talk to you next week. Bye-bye.